Welcome to another Southbank Investment Bulletin. And this week I'd like to focus on what's happening in the USA right now because I think it is going to have a knock-on effect for how markets perform in both the UK and in Europe. And most particularly, that's going to focus on the performance of various currencies. But the focus of attention right now is on the very strong non-farm payrolls figure that came out on Friday. So the survey expected 185,000 new jobs, and that was supposed to be a decrease from the prior number. And instead, it came in at almost double what the expectation was. So, this was an incredible number of new jobs created that was way beyond the expectations of the market. And this, of course, then creates some problems because now let's just pay attention to how did the bond market respond to that kind of news. The expectation has been that the Federal Reserve would be cutting interest rates very soon, and the bond market has been very quick to allow yields to contract, which basically means that people have been buying bonds. And the yield on the 10-year has come in from 5% to about 3.75% over the course of the last 4 months. Now it's rebounding because investors are looking at the pace with which new jobs are being created and thinking, well, how on earth can the Federal Reserve cut interest rates if the economy is so robust? Obviously, when there are more and more people finding work and the unemployment rate is close to historic lows, well, one could, I think, justifiably argue that the evidence of a slowdown isn't nearly as appealing or convincing as it might have been. So then it does push out the timeline for when interest rate cuts might occur. So that has helped to support the dollar. And what it's also doing is putting some upward pressure on yields. But then there are signs of overheating in the stock market, and we've certainly seen some incredible accelerations in some of the tech companies. So Meta, for example, went up 200 billion in value last Friday on the back of very strong cloud sector earnings. So that's a clear acceleration, and I think it's about the most acceleration we've seen from the share since its genesis. But it's the biggest jump in the value of a company on a single day ever. And those kinds of headline really do help to highlight that there has been an incredible rush to try and stake a claim to dominance within the AI sector. And we're talking about vast quantities of money chasing that title. So I think we have the potential right now that what the US economy is doing is overheating, that you have very low unemployment, you have record numbers of jobs being created, or at least, sorry, that might not be a record, but certainly uh, the uh, the surprises that are coming on the jobs creation front are headline grabbing. And then, of course, we have the potential that all of that money that is coming out of the balance sheets of tech companies is getting spent. And there's a lot of infrastructure development that is already in the pipeline because of the Inflation Reduction Act and the CHIPS Act. And that money has not yet been spent. So it's a big source of stimulative action, even though interest rates have come up a lot. Then let's pay attention to some of those smaller banks. So on the same day that, or I guess the same week that Meta went up, New York Community Bank Corp went down, and it is now back in the region of the lows from March of last year, which was when the regional banks were at risk of going bust. Now, part of the reason why New York Community Bank Corp has gone down so much is because of its exposure to uh, the rent-controlled mortgage portion of the New York market. So this is not especially something that is going to have a contagion effect, but because it has come at a time where people are starting to think again about the exposure of regional banks to commercial properties, then it has had a deleterious effect on sentiment. Now, then let's just look at something that's a bit more macro. The M2 relative to the GDP is back to trend. So we can think about what central banks do. What their main job is to manage the money supply and to manage interest rates. So one of the things that they will think about is how much money is appropriate to have in the system. And the easy way of doing that is to take the nominal GDP and divide it into the nominal money supply. And provided you have sufficient money to ensure that GDP can expand, well, then you can argue that there's enough money in the system. So obviously, when GDP goes down, it means you need to have more money in the system. When GDP goes up, you can take some out. And in 2020, it went up. GDP went down a lot, so M2 went up a lot. And over the course of the last 3 years, they've been taking it out. GDP has been improving, and the pace with which money supply has been increasing has been much lower than the rate with which GDP has been expanding. So that has allowed the ratio to contract. So we're now back to the pretty much the trend of what has been evident since 2007. But I would caution to simply look at more back history, because there was a good long time where we did not have nearly as an exaggerated move in terms of money supply relative to GDP. All the way through from the early 1960s to about 1985, or through to 87, we didn't have nearly as much of a consistent trend. And then during the 1990s, where GDP did really particularly strong, and where we had a really profound invention of the internet and technological revolution, then we saw this ratio contracted pretty much the entire decade. But after the credit crisis, we moved into a different phase where there has been aggressive money supply growth relative to GDP. So we're now at the critical juncture. It's an enormous question. When central banks now have this question around inflation, and they are hoping that they can cut interest rates because there is a wall of debt that needs to be refinanced out there in 2025 and 2026. So interest rates need to be lower by the time we get to that point, or there's going to be an enormous default cycle. And that means that they need to get inflation under control now. So they are going to be reluctant to cut interest rates until they have evidence that economic growth is rolling over. And that does imply that unemployment goes up. And then we will see the corollary, which would be that we're either at the end of this cycle that began at the beginning of the credit crisis. And if that's the end, then we'll see a similar move in terms of GDP, or M2 relative to GDP, and it will contract. And that could easily be in tandem with an AI bull market, which would be deflationary and would also help to support the stock market environment. Of course, we could also then be in the same kind of scenario that we're in, which would be that we are going to see another increase in money supply growth relative to GDP. And that would be in response to a much deeper process of deflationary forces and potentially a recession. And then on top of that, there's the obvious potential that if we do see that kind of money supply growth, well, then it is assets like hard assets, like gold and like Bitcoin, are going to do significantly better. So We're at I think a very interesting place in markets right now, and I think we're going to have answers to some of these questions within about the next 3 to 6 months. And I think with that, I'll leave you for this week and wish all the best to all of you.